Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, September 10th, 2024. Hope you're having a fantastical day out there in the interwebs. It is a beautiful day here in Colorado. Lots of sun, not too hot, not too cold. Perfect day. All right. Well, hope you're having a perfect day too. If you could do me a favor before we jump into the news, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. All right, let's get into the numbers for today. Looks like things improved a lot before the market finally closed. Dow Jones was only down 0.23%, 92 points. I think it was down like 200 something at its worst. Closed at 4736. S&P 500 up 0.47%, 25 points. Closed at 5496. It's been a good portion of the day in the red. NASDAQ up 0.84%, 141 points. Closed at 17025. The VIX was down 1.9% today. It's at 1908. Canada down 0.1%. Brazil down 0.17%. And Mexico down 0.33%. Headed to Europe, Germany was down 0.89%. The UK down 0.78%. France down 0.24%. The Netherlands down 0.73%. Spain down 0.61%. Italy down 1.12%. Switzerland down 0.09%. And Portugal down 1.01%. Russian exchanges back in the red. The MOEX down 1.05%, RTSI down 1.85%. And the overnights, the Nikkei was barely up 0.06%, Australia up 0.3%, New Zealand up 0.11%. In China, the Shanghai was up 0.28%, Shenzhen component up 0.13%, China A50 up 0.23%, DJ Shanghai up 0.07%, Hang Seng up 0.22%, and the Taiwan weighted down 0.38%. All right, so those are the markets. Again, everyone's just kind of on pins and needles right now because we got CPI data, I think, comes out tomorrow, and PPI later in the week. And then we got the Fed meeting next week, which everyone's just like, oh, what's going to happen? So, all right, well, let's get into the market recap. Wall Street gained slightly with weakness in banks and energy weighing. All right, on Tuesday, Wall Street benchmarks S&P 500 index saw a slight rise, but concerns about slowing economic growth capped gains. Energy stocks led the declines among the S&P 500's 11 industry sectors, dropping over 2% due to falling crude oil prices after OPEC Plus cut its demand forecast for 2024 and 2025. Bank stocks also fell sharply after Goldman Sachs CEO David Solomon warned of a potential 10% decline in trading revenue this quarter. JP Morgan Chase's president further lowered expectations for income from interest payments, while Ally Financial reported increasing credit challenges, sending its shares down 17%. The financial sector was one of the weakest performers on Tuesday, with JP Morgan Chase and Goldman Sachs both suffering significant losses. Despite the Federal Reserve unveiling a bank capital plan, the focus remained on the weakening fundamentals in the financial industry. Lindsay Bell, chief strategist at 248 Ventures, noted that these negative developments overshadowed positive regulatory news, leading to market caution. Investors were also concerned about the global economic slowdown and the uncertainty surrounding the Federal Reserve's interest rate decision next week, as well as the upcoming U.S. presidential election. Bell suggested that this uncertainty could lead to a weak performance in September and October. In other news, Hewlett-Packard fell 6% after announcing a stock offering to fund its acquisition of Juniper Networks, while Oracle jumped 10.9%, following better than expected quarterly results. Overall, declining stocks outnumbered advancers on both the New York Stock Exchange and NASDAQ, reflecting a cautious market mood ahead of key inflation data later in the week. All right. So again, everyone just kind of sitting around on their hands, just kind of waiting to see where things are going to go. What's the Fed going to do? Is the Fed going to lower rates? Are they going to lower to 0.5%? Woo, that'll save the economy. Anyways. All right. Next article here from Zero Hedge. Ally Financial craters after auto lender reveals surging delinquencies and charge-offs. U.S. consumer credit showed a concerning trend as credit card debt surged, suggesting that consumers facing depleted savings are now relying on credit to cover everyday expenses. This was quickly confirmed by two major financial institutions. JP Morgan, though, through its president, Daniel Pinto, warned that the bank could miss its previous net interest income target, causing a stock to fall by the most since June of 2020. However, the more significant market shock came from Ally Financial, which saw its shares plunge 18%. their biggest one-day drop since March of 20, after management's presentation at a Barclays conference. Ally CFO Ryan Hutchison revealed that auto loan delinquencies rose by 20 basis points in July and August, with net charge-offs also exceeding expectations. The firm's auto loan book has been hit hard as borrowers show increasing vulnerability due to high inflation and a weakening employment market. Hutchison acknowledged that credit card challenges have intensified, signaling a potential underperformance and indicating that Ally may increase reserves to cover bad loans. Ally's news triggered a broader sell-off among consumer-facing card issuers, including Bread Financial, down 9.7%, Synchrony, down 8.6%, Capital One, down 6.9%, and Discover, down 6.9% also. Analysts responded with caution. KBW's Sanjay Sakarani and RBC's John Afstrom both pointed to concerns about the quick rise in delinquencies and charge-offs, though both maintained a longer-term positive outlook. The situation raises questions about whether Ally struggles are company-specific or indicative of broader economic challenges facing consumer credit and auto loans. Well, it's something I've been talking about quite a bit in the last year, that delinquencies have been rising. And, from my previous experience as a decade in the credit and collections part of the banking world, when those go up, it's typically a sign that the economy is not doing great. So, pretty much you could just watch the delinquencies at most of these larger banks, for their credit cards and such. And, I would judge credit cards are usually the first thing people will ignore. The car is second, the mortgage is last. And so credit card delinquencies usually will be kind of your first tell that something is starting to get kind of rickety. But when people, stop paying their car loans, then there's something really bad going on. All right, one last article from our friends over at the Mises Institute, the top 5 lessons for the young economist. And this was written by Jonathan Newman. So let's see what he had to say. The Mises Institute is actively challenging mainstream economics education by promoting Austrian economics through the Robert P. Murphy's Lessons for the Young Economist. In public school, students are taught a biased view of history and economics, favoring government intervention while minimizing the role of entrepreneurs. Hey, yeah, just ask a young person who freed the slaves. And, if they tell you Abraham Lincoln, they didn't get a good education. The educational approach leaves students ill-prepared to understand key economic concepts like opportunity costs, market forces, and the importance of the private sector. The Institute's series of short lectures emphasizes key lessons from Murphy's textbook, beginning with the idea that thinking like an economist means understanding that all actions have opportunity costs. The teachings of Henry Hazlitt and Frederick Bastiat are highlighted, particularly their explanation of the broken window fallacy, which illustrates that destruction does not stimulate the economy, but redirects resources. And for those who don't understand the broken window fallacy, is that those who are, I think, Keynesians, they will look at a broken window and say, hey, we have a broken window. That means that the window guy has business. Well, yeah, but if you didn't, need to replace the window, if it was fine before someone threw a rock through it, now you've had to redirect resources that you would have spent on, if it's your house for yourself personally. If it's your business, it would have been wages or advertising or R&D or whatever. So that's the broken window fallacy. Like I said, versus the Keynesian who'll say, well, that's good for glass makers. It's like, well, we don't go around smashing windows just to put, keep glass people in business. All right. The division of labor is another critical concept. Ludwig von Mises stressed that specialization increases productivity, enabling people to achieve higher standards of living. Profit and loss accounting, essential for efficient resource allocation, is also explained as a vital mechanism for determining consumer demand in the market economy. And that a lot of times they refer to that, the consumer demand as the invisible hand of the market, meaning that prices typically will regulate based upon, the hidden hand of things. Companies can only raise prices so high on, if everyone's selling, I don't know, tennis rackets, and, one company is charging like 3 times more than everybody else, odds are people aren't going to buy it unless it has some sort of an exceptional quality to it that people are like, hey, this is worth 3 times what I'm paying for these other, 5 brands that I could buy from. So, All right, where was I? The lectures also discuss the failures of socialism, particularly its inability to solve the problem of economic calculation and address the misconceptions surrounding inflation. Monetary inflation, driven by government money creation, distorts the economy and contributes to boom-bust cycles. So in summary, the Mises Institute aims to equip students with a solid understanding of free market economics, allowing them to critically assess government intervention and its effects on the economy. So, or just food for thought. I thought that was an interesting article, so I figured we'd cover it today. All right, well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there, so feel free to give me a buzz. I'd be happy to help. All right, well, that's everything that I had for today. Like I said, if anyone needs anything from me, please go to the website. Otherwise, have a great night, and I'll talk to you next time. Adios.